Hello friends, the start of 2026 has been quite something for the equity markets. In fact, it almost feels like deja vu from early 2025. Sharp correction, broad-based nervousness and sense of here we go again, but this time the underlying story is very different and frankly more positive. Let me start with the biggest development. After almost a year of back and forth, India and the US have finally reached a breakthrough on tariffs. India's tariff has been cut from a punitive 50% down to 18%. And that's actually better than what most peer countries are getting. So in effect, Indian exporters now have a competitive advantage. On the flip side, yes, India has opened up many sectors for imports from the US, but honestly, because India's cost of production is structurally lower, we don't see a meaningful hit to the domestic manufacturing. Maybe a few pockets, premium cars, high-end alcohol, but outside of that, the impact on local industry should be quite contained. Just before the US-India tariff deal, India signed a free trade agreement with the European Union. If you add up the US and the European Union, you are talking about markets that together represent roughly half of the global GDP. So, Indian exporters certainly have favorable access to both these giant blocs. That's a very different external environment than what we dealt with over the last 2 to 3 years. Now, combine all of this with what happened just last week, and you can see why the mood is beginning to shift. We had the union budget, the RBI policy, and the US trade deal all within days of each other. And the common thread across the three is this: India is setting up itself for a stronger domestic growth cycle, especially in manufacturing and investments. The budget was very clear in its focus, heavy push on infrastructure, data centers, defense, and targeted schemes across biopharma, semiconductors, electronics, rare earth, chemicals, capital goods, and textiles. RBI, after having cut 125 basis points of short-term interest rates last year, kept the interest rate stable, but upgraded both its growth outlook and inflation expectation. So, where does all this leave the markets? The recent correction has placed Nifty PE below 20 times. Yes, India had underperformed other emerging markets for some time, but now, with domestic growth gaining traction, policy momentum solidly supportive, and external access improving through trade agreements, the setup looks meaningfully better. Investors would be better off putting lump sum money into large cap funds or multi-asset strategy. For small caps, SIPs should be preferred. Happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.